This piece covers FuelCell Energy's Q3 report, a massive 97% revenue jump from a big contract and a new AI pivot, but all set against a huge net loss. We've got this headline: FuelCell Energy explodes with 97% growth. So let's just jump right in.
Yeah, let's. That 97% figure is where we need to start. To maximize the logical robustness of the analysis, the breakdown of that revenue surge needs stronger contextual framing, especially around sustainability and risk.
Right, because the material points out the total revenue, $46.7 million, but then immediately says $26 million of that came from one single contract.
The Gyeonggi Green Energy contract.
Exactly. So the weakness is that it highlights this dependence without really, warning the reader what that concentration actually means.
It's a huge red flag. I mean, if a single product sale drives over half your revenue for the quarter, that's a lumpy one-off event, is it? It's not really a sustainable trend, is it?
Not at all.
So the suggestion here is to clarify the inherent risk when such a massive growth percentage is tied so disproportionately to a single event.
And a concrete way to do that would be to just calculate what the revenue growth would look like without that $26 million. That would force a comparison with the recurring revenue and, well, tell a much more honest story about the company's underlying health.
So we've established the growth is concentrated. But if we flip over to the other side of the ledger, that big loss, we hit another clarity problem.
Right. The $91.9 million net loss. It looks awful, especially at nearly $4 a share. The piece does correctly note this includes a $50.2 million non-cash impairment charge.
It does, but given the complexity of that reported loss, the analysis could be strengthened by clarifying the impact of those impairment charges on the core operational narrative.
You're saying the headline loss number could totally overshadow the actual cash burn for the reader.
Precisely. We need to help the reader differentiate between the loss from actual operations and the one-time, non-cash accounting move that inflated the final number.
So what's the suggestion?
A really powerful way to do this is to just calculate and present the net loss excluding that $50.2 million charge.
Ah, got it.
It gives a much clearer sense of the operational cash burn. You could also connect the negative gross margins analysts flagged directly to that operational loss, before the impairment.
Okay, that makes sense. Now let's talk about the future, because there's this really bullish AI data center pivot, the MOU with Inuverse for up to 100 megawatts.
But then you hit the wall of reality.
Yeah, the analyst consensus hold rating, they don't expect profitability until 2027.
So how do we sell that 100 megawatt opportunity when the experts are just saying hold? The discussion around the new MOU requires a much clearer articulation against that consensus rating.
Right now there's an analytical gap. If the AI pivot is so massive, why are analysts discounting it?
The piece needs a bridge to justify the bullish thesis, that whole buy the dip argument, against all these negative metrics.
And that bridge is
the cash. Use the massive $236.9 million cash fortress as that bridge. The suggestion is to demonstrate how that capital enables this high-risk, high-reward pivot into AI data centers.
Oh, I see. That's what justifies the potential upside targets, even with the current losses.
Exactly. You have to highlight that the whole bullish argument rests on valuing the potential of that 100-megawatt pipeline against the security provided by their cash reserves.
The cash gives them the runway to actually make the pivot happen.
That's the ticket. You directly compare the analyst resistance, the lack of near-term profits, against the upside from future tech adoption, which is all underwritten by that cash on hand.
This has been really insightful. So, to quickly recap the actionable steps. First, really focus on the quality of that 97% growth by isolating that one-time Gyeonggi contract payment.
Second, clarify the core operational loss. Explicitly separate it from the $50.2 million non-cash impairment charge.
And finally, use that huge $236.9 million cash position as the key justification for the bullish buy-the-dip thesis, especially against the current analyst skepticism. We invite you to refine the material based on this feedback and resubmit it for a